If I hear of one more client completely railing themselves by using a redraw account instead of an offset account, I'm going to cry, because it's such an easy mistake to make, but it's a really easy problem to avoid, because redraws have a tendency to be tax traps. Let's talk through them. Let me minimize myself here. Now, they're very easy to confuse because they function in the same way, but they are different. So let's go over here. We'll do an offset first because it's more straightforward. In both of these examples, the person's borrowed $1 million, okay? But they've got a bit of cash left over. They've got $200,000 left over, and that sits in an offset account. Now, an offset account is like a standard transactional bank account, but it sits next to your loan and it works to offset the interest. So no longer is this person paying interest on the million, they're paying interest on the difference between the million and the 200K in offset. So they're only paying interest on the 800,000. That's how the offset account saves you money. And the whole idea is you pummel all that extra money into the offset account, and the more and more money that you get in there, it saves you interest over the life of the loan. Now, that separate transactional bank account is cash that you have access to at any point in time. And lots of people who have this $1 million mortgage will actually get all their pay going into their offset account, because the interest on this loan is calculated daily. And so the more money you get in that offset account, the more interest you're saving yourselves. Now, you can also do this similarly with a redraw account, but let me show you the difference. Now, in a redraw account, this person here also has $200,000 left over. But what they've done is they've borrowed the $1 million and they've paid the extra money into the loan. So they've actually reduced the loan balance from the million down to 800,000. Now, that 200,000 in redraw has been paid into the loan. They still have access to it, like in the same way that this person over here, let me make myself a little smaller. This person over here still has access to the 200,000. This person over here still has access to the 200,000. This 200,000 is working to lower the interest repayments. This 200,000 is working to lower the interest repayments. So functionally, your interest repayment would work the same in either of these instances. The difference being, this person has actually paid that $200,000 into the loan. They have given it to the bank. That money, from a tax perspective, ceases to become cash. It's not cash anymore. The second that money, that 200K touches this loan, from a tax perspective, it becomes what we call borrowed funds. This money over here has never touched the loan. It remains cash from a tax perspective. Now, you might go, well, who cares if it's borrowed funds or who cares if it's cash? It depends on what you want to do with this property in the future. If this is a home that you are going to live in and you are going to pay it down and you're going to live in it forever, it doesn't matter. Either of these would both save you interest. They would give you an identical result. You could fill up your offset account over here. You could pay down your loan via redraw over here. You're in the exact same position. But what happens if you want to change the purpose of this asset in the future? Then you're in trouble. Okay, so I've drawn a different graph here. Let's say 10 years has passed. Now, this person with the redraw has managed to pay off all their loan. So they've paid $1 million into that redraw account, and that loan balance is taken down to zero. They've still got access to the $1 million, but technically that money's been paid into a loan. This person over here has the $1 million of debt still open, but they've paid their $1 million of cash into the offset account. So this $1 million is still open. That $1 million is still not attached to that property. Now, this person, let's say they paid off their first home, which is worth 1.3. For whatever reason, they want to move into another house worth $1 million, but they want to hold on to the first house as an investment. This person who's used the offset account would take this $1 million of cash out of offset and would buy their next home with no debt. So they've got no mortgage repayment on their new house. And what they've then got is $1 million of tax deductible debt against what is now an investment property in order to write off their costs to minimize their tax. This person over here has paid the $1 million into the redraw. Now, they can still access that money, but when they take the $1 million out of redraw and use it to buy their new home, they're using borrowed funds to buy their new home. So what that means is they've actually paid the loan down on the first property. So there is no debt on the first property, and you've taken out the $1 million and you've used debt to buy your new home. So what that means is, in this instance, if you want to change the purpose of the first house, you start like 10 years down the track, this person here has got no debt on their investment. So when they make rental income off that property, let's say they're making $1,000 a week in rental income, they've got nothing to write that rental income off against. So they're going to pay full tax on that. And they've also got $1 million of debt on their new home, which means their mortgage repayments are going to be massive. So they've got no tax deductible debt, and they're paying a lot of tax on the income they're making from that investment. This person over here who used an offset account, they've got $1 million worth of debt on this. So when they're making $1,000 a week in rent, they can write that off against the interest repayments on that home and pay less tax. They've also got $0 of debt on the home that they're living in. So they have no mortgage repayments to speak of. So what you can see here is offset and redraw are both fabulous. Both of them work to offset your interest repayments. For anyone that has a property, either owner, occupier, or investment, you want to get as much money into those accounts as you can. A redraw account has limited flexibility because the money you're popping in there has changed purposes from a tax perspective. It becomes borrowed funds. The money you pop into an offset account does not. It remains your cash. Now, as a summary, if you're going to pay down that home and stay in it forever, this makes no difference to you. Both of those things do the same thing. But if you're going to move on from that home and hold on to the first property, this is a massive problem if you are using redraw, and there are no issues if you are using an offset account. So why on earth doesn't a mortgage broker just suggest this in the first instance if they're working the same, right? But this one limits your future flexibility. The reality is, to do the offset account, there's a tiny fee. It's like $400 a year. So if you're not actually using this offset account, you've got to pay $400 a year extra versus if you did it this way, because a redraw account generally comes for free on a mortgage. But to make that $400 a year, it's $395, make that $400 a year fee worth it, you only have to have about $7,000 in your offset account against the average mortgage to make it worth it. And most Australians have far more than that in cash when they have a home. So for almost everyone, this is going to be a better outcome for you than this. Let me know if you have any questions on offsets or redraws. Mwah! Get rich.